Hello and good morning, friends. Welcome to the CEC-UGC live lecture. Dear friends, as you know that we are carrying a series on financial accounting, and so far we have conducted 2 sessions on financial accounting where we try to understand about the basics of accounting. Dear friends, this is the 3rd lecture in the series. Today in this session, we are going to start from the point where we left in the previous session. We tried to talk about accounting terminology in our previous session. So dear friends, we would be starting from the point where we left, that is from accounting terminology only, and after completing on accounting terminology we would be talking on accounting principles. We are going to understand what are the principles of accounting. So dear friends, for this very discussion on the topics as I explained, as I suggested, for this discussion we have again with us in our studios Mr. MC Sharma. Mr. MC Sharma is Associate Professor in Department of Commerce, Shahid Bhagat Singh Evening College, University of Delhi. Dear friends, Mr. MC Sharma has almost 32 years of teaching experience, and I believe that his experience would help us in knowing the topic, in knowing the entire series. So without wasting any time, I would like to welcome our guest, Mr. MC Sharma. Mr. Sharma, welcome to the EDICET lecture once again.
Thank you. Dear audiences or listeners of this lecture, we are continuing the accounting terminology. In the last session, we discussed transaction, goods, purchases, sales, returns, purchase return, sales return, voucher, assets, and different types of assets, classification of assets. We are continuing this terminology, and one term which is very much popular, that is liabilities. Liabilities are the obligations or the debts which the firm owes to outsiders. The claims of outsiders other than owners are called liabilities. As we know that when we want to start a business, we need to buy some assets, and these assets are financed either by the owner, that is through capital, and or by borrowing the funds. This borrowing the funds is liabilities. For example, loan from banks, financial institutions, there may be creditors, outstanding expenses, bank overdraft, any other type of the borrowing. So the sources of funds are capital and liabilities. So liabilities here we mean the external liabilities other than the owners. So we know that nowadays it is very difficult to run a business without borrowing the money, because a lot of amount is to be invested, and every person cannot invest the whole capital from their own resources. So they have to borrow from banks, financial institution, and other sources. Liabilities may be classified into the 2 parts on the basis of the term of the liability. One is the fixed or long-term liabilities, or the current liabilities. Long-term liabilities are basically normally for more than 1 year. The loans from banks against the mortgage or the debentures issued by a company. Loans may be from friends and relatives also, or other associates, but their term, the repayable period should be after 1 year. So then it is called the long-term liabilities. If the amount is borrowed for less than 1 year, then it is called the current liabilities. Normally it is in the usual course of the business when a firm buys the raw material or the goods on credit basis, and this amount is payable, may be payable after 15 days, 30 days, 60 days, 90 days, depending upon the terms of between the buyer and seller. So this is the current liability, because these are payable in the short term. Other current liabilities may include the outstanding expenses. The salaries, for example, are paid after the month, electricity bill, outstanding telephone bill, or any other expense. These are also the current liabilities. Bank overdraft is also considered a current liability, because it is the short-term finance which is given by the banks to their customers. And there is one more term, that the bills payable, which we'll explain. So the current liabilities from the basis, on the basis of the term, it may be the fixed long-term liabilities or current liabilities. Then capital. As we have already told the business is started by the owner, so capital may be referred as the amount in terms of money or assets having money value which is invested by the owner in the business. A proprietor or the partner can claim his share of capital from the firm, and if the business is closed or the partner retire, the capital is a liability towards the owner thus. So, the total assets are equal to total liabilities, that we can say the internal liability. The capital is also called the internal liability because it is a claim towards the owners, or in case of a partnership towards partners, in case of a company the shareholders. So, that is the capital. It may be invested in cash or in kind in any other format. So, this owner's equity or proprietor's fund or net worth, whatever we claim, the different names can be there, and if in any situation if it is not given, then we could calculate by using this accounting equation, that is the capital equal to assets minus external liabilities. So, the capital is very important term for in every business. And then the drawings. It is the amount which is withdrawn by the proprietor or the partners from his business either in cash or kind for their personal use or domestic use. We know that the owner is dependent for their earnings, for their expenditure on the business. So, he has invested all his money in business. So, whenever he needs any money, so he may withdraw it from the firm for their personal use, or sometimes some goods may be taken by the proprietor for personal use. So, this is the part of the drawings. So, normally it is the practice that the drawings are made by the proprietor against the profits which is being earned by the firm, and at the end of the year this drawings account is closed by transferring to capital to find out the net capital of the owner. So, the capital and drawing, these both accounts belong to the owner. Now, in the debtor is a one term. We have already discussed the assets, and that is the asset is the current asset, and current asset includes debtors. A debtor may be defined as a person or a firm or a company who owes money to the firm, mostly on account of credit sale of goods. So, when goods are sold to a person or a firm on credit basis, the person will pay the price after some time. So, he is called a debtor. Debtor is now very common in the balance sheets of the business or the firm, because most of the business require the credit sale of goods. And opposite to this, that is the creditor. So, creditors are those persons or the firms who have supplied the goods to the firm on credit basis. So, the suppliers are known as the creditors. Till they are paid, they are shown in the balance sheet as a liability. These are both these liabilities are assets. Both these items are normally payable within 1 year or receivable 1 year. So, the debtors is a part of current asset and creditors is a part of current liabilities. In addition to this, these two instruments are also very popular in the business. One is the bills receivable. We all are familiar with the check. We open a bank account, and when we want to withdraw money, bank issues a checkbook. So, we give a order to the bank. So, the check is a order instrument which is drawn by the deposit holder or the account holder on a particular bank. A similar type of order instrument is there in the business area, that is called bills receivable. This is also an order instrument, but this bill receivable is drawn by one party on another party. Normally, when the goods is sold to a person who is a debtor, so we want a fixed promise from the debtor that he will pay after 30 days, 40 days, 60 days, whatever it is the terms of their business. So, the seller may draw a instrument on the buyer to make the payment after fixed period. So, this is called the bills receivable, because the amount of this bill is receivable by the firm. So, it is called the BR, and the same instrument is known as a bills payable. Bills payable in the books of a person on whom the bill of exchange has been drawn, because he has to make the payment of this bill. So, the bill of exchange is an instrument which is in the books of one party, it is called bills receivable, and the same instrument is called in another party as the bills payable. Because bills receivable, because he has to receive the money, so it is the asset shown as the part of the current asset. Bills payable, because the firm has to pay to someone on the basis of this bill, so it is the bills payable, and normally these are for the short term. So this is the part of the current liabilities. There is one more term is used in balance sheets, accounts receivable and accounts payable. Accounts receivable is basically a broader term which includes debtors and bills receivable both, and accounts payable is a term which includes the creditors and bills payable. So it is a combination of the both. So if we want to show the whole accounts receivable or payable amount, then it will include, in case of account receivable, debtors and BR, and in case of account payable, that creditors and bills payable. So these are the some important terms which we have discussed, and there are many terms which we shall continue to discuss in the coming time whenever they will come. Still, if you find that any accounting term which you are coming across and has not been explained, so you can send it to your feedback, and we shall cover in our discussion. Now the core of the accounting that we call, that is the accounting principles. If we want to understand the accounting properly, then we must have the knowledge of accounting principles. We have already studied that accounting is a science. Science means it is based on certain principles. So now we shall start the discussion on accounting principles. If any person has a knowledge of accounting principles and understanding, then definitely he will feel comfortable while learning the accounts, doing the accounts. So this is very important. Although by my experience, I would like to tell you that many people ignore this, particularly students, because they think it is a part of the theory examination, it is only theory. But every numerical is based on all these accounting principles, so you must try to understand them. So now we are starting the discussion on accounting principles. What do we mean by accounting principles? Accounting principles are general guidelines to establish standards for sound accounting practices and procedures in recording and reporting financial performance and status of a business. We know that the accounting has been developed through many years, and during these years, on the basis of the experience and on the basis of some reason or the logic, these accounting principles have been developed by the experts from their field. Accounting is an information system, and it must report the true and fair position and performance of the business for the benefit of the users of the accounts. So to ensure uniformity and easy understanding of the accounting information, the accounting principles are must. All these accounting principles are classified into the two categories. One is accounting concept and another the accounting conventions. So first we would like to start discussion on accounting concepts. Accounting concepts are defined as basic assumptions on the basis of which financial statements of a business entity are prepared. So we are using a term here, the basic assumption. Assumption means that they may not be true in the real life, but for the purpose of accounting records, we assume them. And these are the different concepts which are very important for the purpose of providing the true and fair information on accounting. So all these accounting concepts are basically foundation for formulating various accounting methods and procedures for recording and presenting the business transactions. So these concepts, it is for accounting purpose, not for any other subject, although sometime meaning may be common or different. So we are calling them the accounting concept or assumptions. The most important concept, which is business entity concept. Normally, if we see a proprietor, he start a firm, Suppose Mr. Mohanlal, he started a firm, Mohanlal and Sons. Now the question arises, is there any difference between Mohanlal, he is the sole proprietor, and Mohanlal and Sons? So on the face we find there is no difference, because there is only one owner. Every profit earned by the firm will go to the Mohanlal, and any loss incurred by the firm is to be borne by the Mohanlal. So we are finding there is no difference between the two. Another reason that for that purpose, if Mohanlal and Sons firms has purchased some goods on credit basis and they have not paid to the supplier, then supplier will file a case against the firm, and the Mohanlal being the sole proprietor, this is the liability of the Mohanlal. In case of sole proprietorship business, the owner has the unlimited liability, means all the liabilities of the firm are the liabilities of the Mohanlal. So for the purpose of law and different other aspects, we notice that there is no difference between owner and the firm. But for the purpose of accounting, this concept has been developed, business entity or separate entity concept, or we call it accounting entity concept. It means that for the purpose of accounting, the existence of business or business has a separate and distinct entity from the owner or owners and all other parties also transacting with it. And this is the reason that when we do accounting for the business, for the firm, not for the owner. If owner also has any transaction with its firm, then this will also be recorded in the books of the firm. Just for example, the capital contributed by the owner in the firm is recorded in capital account, and the amount withdrawn by the owner from the firm for his personal use, it is recorded in the drawings account. So these accounts are prepared just due to this business entity concept. If we do not follow this concept, then what will happen? The transaction between the firm and owner will not be recorded, and the profits, true profits, cannot be calculated. We can take a very simple example. You start a business in your home, suppose a provisional store. So it is within your house in the one room. So any grocery item or domestic item is required by the family, they are just coming and taking away, and it is not being recorded. So if it is not recorded, then definitely we cannot calculate the true profit correct for the firm, because the goods purchased is the part of the cost of business. But some goods which were taken by the proprietor for his personal use or his family member has not been recorded, so we cannot calculate the true profit. So this business entity concept is very important, and this is the reason that we do accounting for business, not for the owner. Transaction with owner and accounts will be recorded in the accounting books. So when a new student start doing accounting, so sometimes they feel confusion. So no need to feel any confusion, because for the purpose of accounting, owner and its firm or the business are the separate. So this effect of adopting business entity concept is that we record only firm's transaction, not the personal transaction of the owner. Only those personal transactions of the owner shall be recorded which are with the firm. Income and profit of is the property of the business unless they are distributed among the owner. So profit is earned by the firm, and if it is distributed to with the owner, then it belongs to the owner only. And personal assets of the owner or the shareholders are not considered while recording and reporting the assets of the business entity. So this concept is basic or the core before starting the accounts. Now in the definition of accounting, we discussed that business transactions and events are recorded in terms of money. This is based on money measurement concept. All the business transactions should be recorded in terms of money, that is the currency of the country. So, if they are not measurable in terms of money, they cannot be recorded, and this is the reason that the non-financial events are not recorded in accounting books. So, all accounting entities treat all units of money in the same, irrespective of the time dimension, because we will discuss later that whenever the transaction is taking place, at that time it is recorded in terms of money value of that time. So, money measurement concept all is also related with that, the basic accounting concept, that these should be. And then cost concept. In the last concept, money measurement, we told you that the amount is recorded in terms of money value at that time when transaction is happening. So, all the assets are recorded in the accounting books on the basis of actual amount involved or spent. If nothing has been spent for acquiring an asset or constructing an asset, then it will not be shown in accounting books as an asset. So, the cost concept does not mean that assets always be shown at cost. With the passage of time, the fixed assets are recorded at cost, but the depreciation is deducted. It is systematically the value which is reduced. So, we show the assets not at cost, cost less depreciation. Another concept is going concern concept. We could take one small example for that purpose, that you are an accountant in a firm and the owner has purchased the car for the business for rupees 3 lakh. And at the you deciding that car's life will be the 10 years, and after 10 years this its value may be only the 30,000. So, you have to depreciate 2,70,000 over the period of 10 years. It means that 27,000 you charge as depreciation. So, at the end of the accounting year, you have shown the car 3 lakh minus 27,000, that is 3,73,000. So, owner show a balance sheet and notice that his value of the car shown is the 2,73,000. He went to a car dealer and he asked, what is the value of my car? And he told that, sir, it could be sold for rupees 2 lakh. Now the owner is confused. The true value is 2 lakh or 2,73,000. He asks you, then what answer you can give? Why you are showing at 2,73,000? Its answer is lying in this concept or principle which we call going concern concept. According to this concept, the business enterprises is a continuing one for the indefinite period and it is not at the verge of the closure. So, whatever business transactions are recorded, they are recorded on the basis that these assets shall be used by the firm for a long period and accordingly their depreciation is charged. And so, we make a difference between asset and expenses. Expenses are consumed immediately, they cannot be carried forward, and assets are carried forward. So, it is the reason that we show the fixed assets at cost less proper depreciation as per accounting method. If sometimes a business has been started for a certain period or the specified period, you have a joint venture for 3 years, in that case the accounting will be done on the basis of 3 years and going concern shall not be used. But in case of the normal business, it is assumed that the business has been started for the longer period and it will continue for indefinite period. So, all the assets are recorded on that basis, going concern basis. Dual aspect concept. We know that accounting is also called, accounting method, the double entry system. And many new people say, why we are calling it double entry, why we are doing the twice entry for a one transaction, single transaction. That double entry system is based on dual aspect concept or accounting principle. According to this principle, every business has the two aspects. Both the aspects are recorded in accounting books, and due to this reason it is called double entry system. We could have one example for that purpose. Just when you are starting a business, you contributed rupees 50,000 as capital in the firm. Now how the firm's accountant should record is 50,000. If only one aspect is recorded, only cash is recorded, cash in and increased, then we cannot prepare the balance sheet, we cannot find out the position, and we have to tell that from where we got this cash. So the aspect of this cash received is who is the giver of this money, and when we came to know that giver of this money is the owner, so we credit it to the capital account. It means that every transaction will affect the two parties or two items of asset or expenses or two aspects, whatever it may be. And in accounting, both of these aspects are recorded. So we call it the double entry system. And this is the reason that when you see the balance sheet of a company, you find it tallied. On the one side the assets are shown, the other side capital and liabilities are shown. If we show it in the form of equation, so we find the accounting equation. Accounting equation is assets equal to capital or owner's equity plus liabilities or claim of outsider or external equities, whatever we call. And it is very easy to understand that whatever the assets has been purchased, because to acquire the assets, to purchase the assets, we have to pay the money. So who is providing this money? What are the sources of funds? These sources of funds are capital and liabilities. Capital is provided by the owner or the partners or any other owner, and the liabilities are basically the borrowings of the firm, whether the long term or short term. So always the sources of funds will be equal to application of fund. So sources of fund, that is capital plus liabilities, and application of funds, the assets, whether these are the fixed assets or current assets or the cash in and lying with the firm. So the dual aspect. So whenever we start any transaction, we have to see which two accounts are affected, which two aspects are affected. The effect of a transaction may be only assets or only external liabilities or only capital. We may like to see with the help of the few examples. The first example is Ram started business with cash rupees 70,000. When we put this in the form of accounting equation, cash is the part of asset, so the asset increased and it is contributed by the owner, so this is the capital. So when we are putting this in this equation, we are finding assets 70,000, external liabilities nil, capital 70,000. So the total assets are equal to liabilities plus capital. Now we add another transaction to this form. Purchased furniture rupees 8,000. Now we could create a new equation. The cash now 62,000, because out of 70,000, 8,000 has been spent on purchase of furniture. So the cash is 62,000 and another asset acquired, that is 8,000, thus total assets are 70,000. No change in liability, no change in capital. So this is the new equation, and again correct, assets equal to liabilities plus capital. One more transaction, goods purchased for 12,000 on credit basis. So goods is the part of the stock of the firm. So now the firm has the three types of assets: cash in hand 62,000, furniture 8,000 and stock 12,000. So the total assets are 82,000. Out of this, 12,000 is external liability, that is creditor for goods. in this transaction which has been created, and the 70,000 the capital. So, whenever we have any transaction, business transaction, we will notice that it affects has the two aspects. There only assets may be affected, like in the previous transaction we saw the furniture purchased. So, one asset furniture increased and another asset cash decreased. So, the total is the same. Sometime it may be affecting only the other side, that is liabilities. So, if there is a liability from a loan from your friend 50,000, so you borrowed from bank and paid to your friend, so the total liability remains the same. It means only liabilities are affected. Sometimes they may affect the one item on the left side, that is asset, and another item on the right side. Like we purchase the goods on credit basis. So, one item the stock is affected on the left side assets, on the right side the liability is increased. So, we could see that every business transaction or events has the two aspects, and both are to be recorded in accounting, and this is the basis of the double entry system, and this is very important for accounting. In accounting, we know the basic purpose of accounting is to calculate profit and the financial position. Profit means we know the income of the firm and expenses of the firm, comparing, then we can get the profit. So, when we recognize our revenue or income, for that purpose a concept or principle is realization or revenue recognition concept. Why it is the accounting concept? Because the different other person may take it otherwise. So, in accounting concept, the revenue is recognized only when a sale is made. Now, the question arises, how we shall find out the sale has been made or not? We could define it that if the sale, either cash has been received by the firm against the sale of goods or sale of services, rendering services, then it is recognized. Sometimes it is on credit basis. So, the buyer has promised to pay in future. So, he has a legal obligation to pay. So, when either cash is received or a claim has been acquired by the firm, only then the revenue or the income shall be recognized or the sale shall be recognized. We could see, suppose a known person to you has taken some goods from your shop and advised you that, sir, I am taking it, if I like I will keep it and pay you, if don't like I will return it. This is called the goods on sale or return basis. Now, the question arises whether it should be recognized in accounting books as sale or not. As we are understanding this transaction, that the buyer has not promised to pay confirm. He told that if he liked he will keep the goods and will pay. It means the claim has not been created. So, it cannot be recognized in accounting books as revenue of the firm, as income of the firm. Basically, it helps in avoiding inflating the profits. It means any firm cannot have the fake sales and cannot have the higher profits than actual. There are certain exceptions to this concept, realization concept. One exception is long-term contracts. Suppose a firm has taken a contract to construct a building and that building shall be completed in 3 years, suppose, large building for a factory, big plant. It means that the final claim, that the contractor will get the money or the payment normally when the contract is completed. But we cannot wait to calculate the profit for 3 years. We have to calculate profit normally annually. So, in this case, although the contract has not been completed, still the contractor is getting some payment on partial completion basis, work completed and certified by some engineer or architecture. So, in case of the long term contracts, normally a proportion of the work completed or cash realized basis is recognized as a revenue. So, this is different or as an exception from the normal realization concept. Second exception is for those items which have a ready market, like in case of the gold, silver and some other precious metals or the other items which has a ready market for sale. So, in these industries the revenue is considered recognized as soon as these items or the goods are manufactured, because those can be sold in the market easily. Another exception is uncertainty. When realization of revenue is uncertain, whether the firm will get the payment or not. So, goods has been delivered or services has been rendered, but the seller or the firm is not sure of getting the money. In that case, the revenue may be recognized on cash basis, the amount received, particularly when the goods is sold on installment basis or hire purchase basis. Most of the vehicles are sold on credit basis and the basis is hire purchase basis. Hire purchase means that when a customer is not able to pay the installment, the seller can take back repurchase the goods sold, and all the installments paid by the buyer shall be forfeited. And many times you see some news in the newspaper or on the media that a person is complaining that the car has been taken by the seller. He has not paid only the one installment, he has already paid the 20 or 25 installments. So, in that case, the hire purchase system, under the buyer is basically has purchased ownership. In hire purchase system, the ownership is not transferred till all the installments are paid by the buyer. When all the installments are paid by the buyer, only then the ownership shall be transferred to the buyer. So, the people are not knowing this concept. So, there is an uncertainty for the firm. Buyer may be defaulter at any time, then the firm may not get the remaining installments or the remaining part of the sales. In that case, there is uncertainty, so the incomes are recognized by the firm revenue on the basis of the cash realized. Accrual concept. We have studied two bases of accounting. One is cash basis, another is accrual basis. In case of the cash basis, incomes or the accounts are recorded or incomes are reported on the basis of the cash realized basis. In case of accrual concept, business transactions are recorded as and when they occur, not when the related payment has been received. This is called accrual basis of accounting, and this is the reason that we made adjustment for accrued revenue cost at the end of the year. The some salary for the March has not been paid but has become due, so we have to show it. So, it is the accrual concept. So, in accounts, particularly for the business firms, all the recording of transactions is made on accrual basis, not on the cash basis, and this is the reason that we make adjustments for outstanding expenses, for prepaid expenses, for accrued income, for income received in advance. They have their own impact on the income statement and balance sheet. Accounting period concept. Now, the question arises, for which period the profit and loss account and balance sheet should be prepared? For a week, for a fortnight, for a month, for a quarter, 6 months, 1 year, 2 year, 3 year. For that purpose, we know that the financial accounting is basically an information system, and it has to report the information to the related parties, about the performance of business. So, for the purpose of comparison and other reasons, tax liability and many others, the accounting period is basically the annual, 1 year, 12 months we could say. And previously the many people were using the accounting period as per their own wish. Some people are starting their books from Diwali to Diwali, some any other 1st January to 31st December, that is the current calendar year. But now the government has prescribed for all the firms that they should prepare their financial statements for the financial year. That starts from 1st April of the year and ends the 31st March of the next year. Although there is no restriction, if a firm want to inform the performance of their business to their investors half yearly, quarterly, etc., as whatever they wish. But normally for the purpose of the government records, the annual accounts are prepared, and that is on the basis of the financial year. Your tax liability, filing a return for any other purpose. In this concern, we would like to tell you that for the listed companies, those companies who are listed on any stock exchange, as per SEBI guidelines, they have to report the quarterly performance to their investors or the related parties. So, this you will find that the parties are getting information early. In newspaper you will find quarterly result and on the TV and different channels. So, that is for those, but the annual accounts are prepared annually for the financial year. Now, matching concept. How to calculate profit? It is based on this matching concept. According to matching principle, the revenue of a given period should be matched with the expenses of the same period. If we are calculating the profits for the financial year 2014-15, it means the revenues of the 14-15 year should be matched with the expenses of the 14-15 year, 2014-15, the same period. It is not possible to calculate true profit if we match revenue of the one period with the expenses of the other period. We cannot calculate the true profit. So, this is the matching concept, and this is the reason that we have to make the many adjustments. Suppose in 2014 and 15, some amount which belong to the previous year has been paid. So, it will not be part of the current year expenditure because it does not belong to the current year. So, in the current year we shall compare or the match only current year's revenue, whether they have been received or not, as we have already studied on accrual basis. Similarly, the expenses incurred for the current year, whether they have been actually paid or not. So, these revenues and expenses are compared to calculate profits or the losses incurred. So, these are the important accounting concepts which has been well defined, and we have to use them in accounting. Accounting is an information system, and it must provide the valuable information to the different users, that is the management, investors, government, researchers, employees, suppliers, banks, and all that. So, certain understanding should be there, easy to compare they should be there. We have already studied this, the 4 attributes or qualitative characteristics of accounting information, that is reliability, that is comparability, so understandability. So, how we can provide these characteristics to this accounting? For that purpose, there are some conventions. Conventions basically are customs. We are using them traditionally or practicing them while preparing the accounts. These are based on the general agreement or the common consent among the accounting bodies and the business houses. Okay, how to prepare the accounts, how the different items should be treated. And there are the four important accounting concepts. One or the first one is the consistency convention. As we know that the data should be comparable. How it can be comparable? How we can compare the one firm's accounting information? If the one firm is using a different method, different accounting policy, then they cannot be compared with the other. So, as per this convention, financial statement should be prepared on the same basis as that of the preceding period, so that we can compare the 2 periods or 3 periods accounting information to draw some decisions or conclusions. So, whatever may be accounting policies or methods, once decided, these are to be followed consistently. So, we call it the consistency convention. But it does not mean that the firm once has the accounting policy, it cannot change. One accounting method adopted is cannot change, it can change. But it should try to use them consistently, continuously. It will provide comparability to the accounting data of the same enterprise over a period of the different enterpriser also. In the consistency convention, I told that it is not necessary, it does not mean that you cannot change. The firm, if it is required necessary, any accounting policy or method can be changed by the firm. And we know that it will affect the financial results and financial position of the firm. So, basically whenever we are introducing any change, we should give the justification for that change, okay, why we are changing it and how it is affecting the accounting information in comparison of the previous method. So, normally this information or disclosure is made as a notes to the financial statements. So, whenever you study any income statement of a company or balance sheet of a company, for a right conclusion or right decision, you must definitely study the notes also. Okay, why there is a major change in some items, so that may be due to change in accounting policy or accounting method. So, for a correct information, we should also read carefully the notes to the financial statements. Normally we avoid them, we do not read, just see the profit, capital, owners fund, assets, all that. We could have some examples of consistency convention, and one is change in the method of valuation of a stock. Although there is one principle which we shall study later, that stock may be valued by the different firms in the different method or the same firm in different method. Few methods used are first in first out, last in first out, simple average cost, weighted average cost, like that. So, different methods are used by the firms for the valuation of stock. So, there may be a change in method of the valuation of stock, and it will definitely affect the financial position as well as the profits of the firm. So, whenever a firm is changing the stock valuation method, it must disclose as a notes to the balance sheet or profit and loss account. Okay, the accounting inventory valuation method has been changed during the current year, and a reason they have to give why they have changed and how it is affecting the performance or the current profits. They have to normally disclose if the old method has been used, then the profit will be this figure, and due to this new method the profit already given in the income statement. Another flexibility area is the depreciation. There are different methods of charging depreciation. Normally two are used, the straight line method or fixed installment method and written down value method. There are many other methods also. So, a firm may use the different depreciation method for the different assets, and sometimes it can use. So, they can change when they are changing the depreciation method, they have to disclose. The rate of depreciation can also be changed by a firm, again they have to disclose. So, the rate of method or the method of depreciation or rate of depreciation, anything is being changed, they must disclose. In final accounts, if you see income statement, you may find one item, that is provision for bad and doubtful debts. This provision is made for the possible bad debts out of the current debtors. Now, it is required how they have been estimated, although they are based on their basis of the past experience, that 2%, 3%, 4% may be bad out of the current debtors. So, whenever this has been changed, so they have to tell the reason. Last year we made a provision at the rate of 3% and now we are making a provision for bad debts at the rate of 5%. So, why we have changed this the rate of making a provision for bad and doubtful debts? So, the justification should be given and they should also show the impact of change. So, normally it is assumed that the accounting policies are consistent from one period to another period. This provides comparability to accounting data, and comparability, if lost, the relevance of accounting data will also be lost, because it may not help the desired objective, that is the decision making for the different interested parties. The next convention, it is conservatism or prudence convention. Conservative, the simple meaning is the playing safe or with a caution, and playing safe in accounting, how does it affect? So, as per this convention, the accountant should not anticipate income and should provide for all possible losses. This is the core of this convention, that the possible income should not be recorded, expected income should not be recorded, but if there is any possible loss, those should be recorded or recognized in accounting books. We will see the different examples for this also. The faced with the choice of the two methods of valuing an asset, we could apply the two methods to value a particular asset. Now, the question arises, which method should be adopted or considered for valuation? We have to choose a method which leads to the lesser value. Lesser value means that we are not inflating the assets. So, basically we are playing safe because the increased value may not have been realized in future. The main objective of this convention is that the financial statement should disclose the actual results, not the inflated results, and there should be no deliberate attempt by the accountant or any other person made to understate the profits or value of the assets. So, basically the financial statement should show true and fair position of the firm, true and fair profits. So, to show the true and fair profits, we must adopt this. We can understand this with the help of some examples. In accounting, the stock is valued at cost or market price, whichever is less. For example, the cost of a stock is 20,000 while market price is 25,000. So, accounting books will show this stock at 20,000. The reason, we are following the conservatism or prudence concept. Suppose we show a stock at 25,000, that is the market price. It means our profit shall be increased by rupees 5,000. In future, we may find there is a decrease in price. So, this year we are showing the inflated profit and next year it will decrease the profits, next year's profit. So, and another reason that the businessman thinks that, or accounting people, this profit has not been earned by the firm in cash, it is a market price, we have not sold the goods, and the profits which we have not earned in cash, we have to pay the income tax on the profit shown. It means that we are paying profit tax on the profit which we have not actually earned. So, it does not make any sense. So, the prudence concept we follow, this will not be the situation. We also make a provision for bad and doubtful debts in the financial statements in anticipation of the actual bad debts which may incur in future. Our debtors are suppose in the books 80,000 rupees, and on the basis of past experience we know that some customers may not pay this amount, they may be the defaulter. So, on the basis of past experience we try to show these total debtors at their actual realization price, which is lower. So, we studied that the cost or market price, whichever is lower, same, the book value of debtors and the expected realizable value of debtors. If expected realizable value of debtors is less, then we should show debtors at the less value and make a provision for the bad debts, although this is not the actual loss, the possible loss. So, this is the prudence concept, should recognize possible losses and expenses, but not possible incomes or gains. In case of the partnership firm, there may be a joint life policy subscribed by the firm, and the policy amount may be the higher, like 3 lakhs policy has been taken, actual premium paid is 60,000. Now, the question arises, the policy should be shown as 3 lakh or policy should be shown at the 60,000. If the surrender value is less than 60,000, then the policy will be shown at the surrender value, which is the net realizable value of that policy. Then there is a convention of full disclosure. According to full disclosure, all necessary information, significant information should be disclosed in financial statement, so that nothing is hid and everything is clear, transparent, and every person can know about these books. Some information which may not be shown in the financial statement separately, they are disclosed as the footnote in the balance sheet. And disclosure of any fact regarding any possible loss and post balance sheet transaction or previous period transaction or event which may have been ignored, they should be disclosed in the as a footnote. And we show that change in method, change in valuation of stock, any loan taken by the company after the making the balance sheet, and contingent liabilities which are expected liability may not or may not have. Relating to this full disclosure, there is another convention, that is the convention on materiality. If we try to show each and every information, there may be hundreds of items in the balance sheet on profit and loss account, may be very lengthy, people may not understand clearly what is this. So, the convention of materiality is followed by the accountant. Materiality means if any information that is significant. When it is significant? When it may affect the decision of the information user. It may have the impact on the decision by information user, then it is material. So, basically it is exception to the full disclosure. Each and every information which is material, that should be disclosed in the financial statements. So, these full disclosure and materiality, these both are interrelated. So, these are the 4 conventions which we have to keep in mind while preparing or understanding the accounts. And I hope your feedback will definitely improve the further content. So, please do not forget to give your feedback and any item missing which you are interested in understanding that.
Thank you so very much. And as Mr. MC Sharma himself said, that if you want to give your feedbacks are most welcome. The queries which you are required, as well as if you want to have a session on particular topic, then you can mail us at info.cc@nic.in, and you can view this lecture the number of times you wanted through YouTube, as we are going to upload this very soon on YouTube. We would be meeting again very soon. Till then, take care. Goodbye. Thank you, sir.
Okay.